Hi, it's Eric Nuttall of the Ninepoint Energy Strategies for a quick recap of the week. It was a volatile one. We've had to deal with ongoing tariff uncertainties. And then we woke up Monday morning to news over the weekend about DeepSeek, a new AI platform that suggested that it would be far less expensive and far less energy intensive. And so we had a real ricochet sell-off Monday. I think it was one of the largest sell-offs in modern history for the stock market. Losses in excess of $1 trillion. We had everything from AI stocks to the trickle-down impact on power producers. Uranium stocks were down as much as 15%. US natural gas stocks were down over 10. And so from the next couple of days that follow that period, what we think we've learned is that a lot of the sell-off, clearly, as is usual, was fear driven based upon a massive uncertainty at the time. It's very early, but early data would suggest that DeepSeek search queries use roughly 40% less power than a typical ChatGPT. We know a search on ChatGPT uses 10 times the power consumption of a Google search. And so, DeepSeek's only 6 times. When we look at the thesis in terms of why we're bullish on natural gas, very little of it involves the increase in power demand stemming from AI and data centers and such. And honestly, there was a little too much hot air into that theme for a period of time. We're bullish on natural gas because we see US LNG capacity roughly doubling between now and 2030, representing about 12 to 14 BCF a day of incremental demand. So if in that context, if you look at AI, the most aggressive assumptions didn't really have any meaningful growth till 2027, 2028. We've seen a wide range of numbers, but it's really a fraction of the increased demand in LNG. And so we think on Monday as well, part of the weakness in natural gas and gas stocks were related to a change in weather models for the month of February, pointing to warmer weather. It's always been the reasons why we've been cautious in natural gas until the build out of LNG reaches critical mass. And so as we see in terms of gas pricing, we're still using about a $4 base case this year. We do think there's a strong call on gas in 2025 and beyond. We have forecasts from companies like TC Energy forecasting an increase of 40 billion cubic feet per day of gas demand. So that's about a 25% uplift. And so when you think about where is that gas going to come from, it's really there's a call on more marginal basins, primarily the Haynesville. There's 2 schools of thought. We refer to like Tudor Pickering, Matt Portu does very, very, very good work on natural gas, thinks about a $4 base is required. We had a private Haynesville company about a week or two ago say that $5 is necessary. We're running with 4 to try to be conservative as a medium to long-term natural gas price deck. And so our bullish thesis on natural gas was not impacted materially from the news that we had coming out on the weekend and the sell-off on Monday morning. Turning to oil, we have to deal, especially specifically in Canadian oil, the ongoing concerns about tariffs potentially being implemented this weekend, 25%, maybe, maybe not. A lot of if-thens. We've been adding to Canadian oil names that have been getting especially beaten up over the past couple of weeks based upon these concerns. We're buying in many cases. One example is a debt-free oil sand company with at least 50 years of stay flat inventory, where we think at $70 to $75 oil pre-tariffs, we're going to be buying back roughly 14% of the stock this year. We do think that tariffs will not be implemented on oil. We've spent a lot of time discussing that. I'm not going to bore you with those details, but effectively, Canada is the cheapest, safest, and most reliable source of supply. And a lot of our oil goes to refineries in PADD 2 around Chicago, which have no other alternative. So plus we know, or we believe at least, the tariffs will be almost all, or if not all, pass through to the US consumer at a time when inflationary pressures are still alive and well. We hear stories about egg pricing, etc. And so we don't think oil will be applied to tariffs if tariffs are implemented. There were some comments yesterday from the nominee for Commerce Secretary that seemed to be fairly reasonable and de-escalatory, talking about just the need to increase border security, and we'll spend time addressing that. But it seems like it's a solvable issue, and a 25% tariff on Canada is the equivalent of economic nuclear war over an issue that should be addressable by our provinces and federal government. Specifically on oil, we've had a bit of a sell-off. Reflecting on data that we got this week, we posted Kepler global inventory levels earlier in the week, showing that they're falling at a time when they normally rise, so pointing to tightness. We had an estimate from Mike Roth, my Cornerstone, showing that real-time demand appears to be up over 2 million barrels per day, year over year. Global inventories are now at their lowest levels in recorded history being going back to 2017. That's as far back as satellite data goes. With the US government put out inventory numbers on Wednesday, and while gasoline did build, there's some noise in the data right now due to what's been happening in the Gulf. What we see is US big three, so oil, gasoline, distillate remain at multi-year lows, and US oil inventories remain very, very low as well. And so the picture that we put up with that chart is this is not what a oil bear market looks like, and yet the market remains in this funk where there's this belief that demand is weak, primarily around China, which is factually correct, but global demand remains decent. This notion that US supply, because of drill, baby drill, et cetera, and I look forward to the day where I don't have to talk about that anymore, but it's very common on a daily basis to have commentators on CNBC and even BNN talking about, Trump, drill, baby drill, we're going to get this surge of production, et cetera. It's complete foolishness. You look at the guidance from service companies, which we've been putting up on Twitter, Liberty Energy Services, which was a pressure pumper just this last night and this morning, reported, and they said, look at, oil producers are basically looking to try to just keep production flat, and they're looking for the actual amount of frac activity to be flat year over year. That is not suggestive of some magical surge in production where producers are going to, answer the call of Donald Trump and not that of their own investors, increase oil production magically, crash the oil price, especially when in 2024, US shale grew at its slowest pace since its inception. So we remain bullish on the outlook for energy stocks for 2025, especially those that are being impacted by profound tariff uncertainties. We are seeing that impact sentiment profoundly. We are seeing that impact funds of flows, where you see redemption levels, you see companies being really beaten up on those worries. And so we remain optimistic that hopefully in the coming days, specifically around the 25% tariff on Canada/Canadian oil, we'll have some certainty on that. I'll be on BNN Monday afternoon to discuss the outcome, whether it's positive or negative. And so we appreciate your time, and we look forward to next week's update.